Hello, and welcome to this channel, where we explore the exciting world of finance through the lens of books. I'm thrilled to be your guide on this journey, as we dive into some of the most fascinating and thought-provoking financial literature out there. Whether you're an investor, entrepreneur, or just someone looking to level up their financial game, this channel is for you. Through our book summaries, we'll explore different perspectives on money management, investing, and wealth building, and distill the key takeaways so you can apply them to your own life. So, whether you're a seasoned pro or a curious newcomer, join us as we explore the world of finance, one book at a time. Hello, friends, and welcome to another episode of our book exploration series. Today we'll be discussing the renowned work, The Intelligent Investor, by Benjamin Graham. We'll take a systematic approach to understanding the principles of value investing that have served as a foundation for many successful investors, including the legendary Warren Buffett. Throughout this exploration, we'll focus on the essential concepts that differentiate true investing from mere speculation. We'll delve into topics such as intrinsic value, margin of safety, and the importance of emotional discipline in the face of market volatility. Join me as we study the teachings of Benjamin Graham and learn how value investing can lead to financial stability and wealth creation. Whether you're an experienced investor or just starting your journey, The Intelligent Investor has valuable insights for everyone. Let's begin this insightful adventure together and expand our knowledge of the investment world. So sit back, relax, and let's embark on this exciting journey together. Chapter 1. Investment versus Speculation. In the first chapter of The Intelligent Investor, Benjamin Graham draws a clear distinction between investment and speculation. Graham defines investing as a disciplined and analytical approach focused on long-term growth and the protection of capital. Investors make decisions based on the underlying value of assets and their potential to generate consistent returns over time. Speculation, on the other hand, is driven by short-term price movements, hope, and market fluctuations. Speculators often base their decisions on market sentiment and attempt to profit from rapid price changes rather than the intrinsic value of assets. They are more focused on timing the market and making quick gains, often taking on substantial risks in the process. Graham urges readers to adopt a prudent investor mindset, which emphasizes the importance of long-term goals, risk management, and a focus on investments that offer intrinsic value. He contends that a successful investment strategy must be based on sound principles, which include understanding the differences between investing and speculating, conducting thorough analysis, and maintaining a disciplined approach. The author also highlights the importance of emotional discipline in investing, as investors often fall prey to fear or greed, leading to irrational decision-making. By managing emotions and adhering to a set of guiding principles, investors can navigate the volatile world of investing more effectively and avoid the pitfalls of speculation. Chapter 2. The Investor and Inflation. In the second chapter, Graham discusses the impact of inflation on investments and the need for investors to protect their purchasing power. Inflation refers to the general increase in prices and the subsequent decrease in the purchasing value of money over time. As a result, investors must be mindful of the effects of inflation on their investments and seek ways to mitigate its impact. Graham explains that the real value of money erodes over time due to inflation, making it essential for investors to include assets in their portfolios that can act as inflation hedges. These assets should have the ability to preserve, and ideally, grow their value in the face of inflation, ensuring that investors can maintain their purchasing power. The author suggests that investors consider a diversified mix of assets, such as stocks, real estate, and precious metals, to hedge against inflation. Historically, these assets have demonstrated the ability to maintain and even increase their value during inflationary periods, providing a measure of protection for investors. Graham also emphasizes the importance of a well-balanced, diversified portfolio in protecting against inflation. By spreading investments across various asset classes and sectors, investors can reduce their exposure to any single investment or market, lowering their overall risk and increasing the likelihood of preserving their purchasing power. Chapter 3. A Century of Stock Market History. In the third chapter of The Intelligent Investor, Benjamin Graham presents an overview of a century of stock market history to provide context and understanding for investors. He emphasizes the importance of learning from historical trends and events to inform investment decisions and avoid common mistakes. Graham discusses several key periods, such as the Roaring Twenties, the Great Depression, and post-World War II booms and recessions to illustrate the cyclical nature of stock markets. These examples serve to remind investors that both bull and bear markets are temporary, and maintaining a long-term perspective is crucial for success. The author also addresses the concept of market efficiency and the role of human emotions in driving market movements. Despite improvements in information dissemination and technology, markets continue to be influenced by investor psychology, leading to periods of overvaluation and undervaluation. By recognizing these patterns, investors can identify opportunities and avoid pitfalls. Graham further highlights the importance of diversification in the context of market history. The past has shown that different sectors and industries can experience varying levels of growth and decline at different times. A diversified portfolio allows investors to capitalize on opportunities while reducing the impact of market fluctuations on their overall investments. Chapter 4. General Portfolio Policy. The Defensive Investor. In the fourth chapter, Graham introduces the concept of the defensive investor and provides guidelines for constructing a resilient and profitable investment portfolio. A defensive investor is characterized by a focus on risk management, capital preservation, and long-term growth, rather than chasing short-term gains or speculating on market trends. Graham suggests that a defensive investor should aim for a diversified mix of stocks and bonds, with a general allocation of 50% to each. He notes that this ratio can be adjusted based on an individual's risk tolerance and market conditions, but should not deviate too far from this balanced approach. The author also provides criteria for selecting individual stocks for the defensive investor. He recommends focusing on companies with a strong financial position, a history of consistent dividend payments, and a reasonable valuation. By adhering to these criteria, defensive investors can minimize risk and build a stable foundation for their portfolios. When it comes to bonds, Graham advises defensive investors to prioritize high-quality corporate and government bonds with varying maturities. This approach helps reduce the risk of default while also providing some protection against interest rate fluctuations and inflation. Chapter 5. The Defensive Investor and Common Stocks. In the fifth chapter, Graham delves deeper into the topic of common stocks for defensive investors. He explores the role of common stocks in a defensive investor's portfolio and provides guidance on selecting and managing this asset class. Graham reiterates the importance of diversification and urges defensive investors to include a broad range of stocks from different industries and sectors in their portfolios. He suggests that investors consider utilizing low-cost index funds or exchange-traded funds, ETFs, as a straightforward and cost-effective way to achieve diversification. The author also addresses the topic of dividend-paying stocks, highlighting their potential benefits for defensive investors. Dividend-paying stocks can provide a steady stream of income and may offer greater stability during market downturns. However, Graham cautions investors not to focus solely on dividend yield, but to also consider factors such as financial strength, growth potential, and valuation. In this chapter, Graham also discusses the concept of dollar-cost averaging, a strategy where investors consistently invest a fixed amount of money at regular intervals, regardless of market conditions. This approach can help defensive investors minimize the impact of market fluctuations and reduce the risk of poor market timing. Lastly, Graham emphasizes the importance of patience and discipline for the defensive investor. By maintaining a long-term perspective and sticking to their investment principles, defensive investors can navigate market volatility and achieve steady growth over time. Chapter 6. Portfolio Policy for the Enterprising Investor. In Chapter 6, Graham outlines the portfolio policy for the enterprising investor. Unlike the defensive investor, the enterprising investor is willing to put more effort into their investment activities and take on additional risk in pursuit of higher returns. In this chapter, Graham focuses on the negative approach, what the enterprising investor should avoid. First, Graham warns against the temptation to engage in market timing strategies. Attempting to predict market movements and buy or sell securities based on these predictions is a risky and often futile endeavor, even for seasoned professionals. Next, Graham advises against chasing performance or investing in hot sectors or industries. This behavior can lead to investors buying overpriced assets increasing the risk of losses when the market corrects. The author also cautions enterprising investors against over-reliance on the advice of so-called experts or investment newsletters. While these sources can provide valuable insights, investors should always conduct their own research and analysis. Graham further recommends avoiding speculative, low-quality, or poorly managed companies. These investments may offer the allure of high returns, but they also carry significant risks and can lead to substantial losses. Lastly, Graham encourages enterprising investors to resist the impulse to be overly active in their investment activities. Constant buying and selling can result in higher transaction costs, tax implications, and ultimately, lower returns. Chapter 7. The Enterprising Investor and Common Stocks. In the 7th chapter, Graham focuses on the positive side of portfolio policy for the enterprising investor. He outlines several investment strategies that have the potential to yield higher returns while adhering to sound investment principles. One strategy is the selection of undervalued stocks, which are securities trading below their intrinsic value. By conducting thorough research and analysis, enterprising investors can identify these opportunities and capitalize on them. Graham also introduces the concept of special situations, involving corporate events such as mergers, acquisitions, and spin-offs. These events can create unique investment opportunities with the potential for above-average returns. Lastly, the author discusses the potential for investing in distressed or workout securities. Priced at a discount due to perceived risk, careful analysis of these situations may reveal opportunities with a favorable risk-reward profile. Chapter 8. The Investor and Market Fluctuations. In Chapter 8, Graham addresses the topic of market fluctuations and their impact on investors. He emphasizes the importance of maintaining a long-term perspective and not getting swayed by short-term market movements. Graham introduces the allegory of Mr. Market to illustrate the irrational behavior of the market and the importance of staying disciplined. He encourages investors to view market fluctuations as opportunities to buy or sell stocks at favorable prices, rather than reacting emotionally. The author also warns against attempting to time the market. Instead, he recommends focusing on the intrinsic value of individual securities and making investment decisions based on fundamental analysis. Graham concludes the chapter by reiterating the importance of a disciplined, long-term approach to investing, which can help investors navigate market fluctuations and achieve steady growth. Chapter 9. Investing in Investment Funds. In Chapter 9, Graham explores the role of investment funds in an investor's portfolio. He discusses the benefits and drawbacks of various types of funds, such as mutual funds, index funds, and closed-end funds. Graham highlights the advantages of index funds, including low costs and diversification. He believes these funds are particularly suitable for defensive investors seeking a passive, long-term investment strategy. The author also discusses the performance of actively managed funds, cautioning that many fail to consistently outperform their benchmarks. He advises investors to carefully consider management fees and past performance before investing in actively managed funds. Lastly, Graham touches on closed-end funds, which can sometimes trade at a discount to their net asset value. Enterprising investors may find opportunities by identifying and purchasing undervalued closed-end funds. Chapter 10. The Investor and His Advisors. In this chapter, Benjamin Graham addresses the crucial role of financial advisors in an investor's journey. He underscores the importance of trust, expertise, and aligned interests between the investor and their advisor. By cultivating a strong relationship with a reliable advisor, investors can receive valuable guidance, refine their investment decisions, and ultimately enhance their long-term returns. Graham provides helpful tips for evaluating financial advisors. He encourages investors to examine their advisor's track record, ensuring they have a history of success in managing investments. Additionally, it is essential to understand their fee structures, as this can impact overall returns. Transparency in fees is vital to ensure that the advisor's compensation is reasonable and justifiable. Another important aspect of selecting a financial advisor is ensuring that their investment philosophy aligns with the investor's objectives. An investor should feel confident that their advisor understands their risk tolerance, financial goals, and investment preferences. This alignment can help create a harmonious relationship and facilitate the achievement of the investor's financial objectives. Chapter 11. Security Analysis for the Lay Investor. In this chapter, Graham introduces the basics of security analysis, teaching readers how to assess a company's financial health and evaluate its prospects for future growth. He explains key financial concepts and documents, such as financial statements, balance sheets, and income statements, and provides guidance on interpreting these documents to make informed investment decisions. By understanding the fundamentals of security analysis, investors can better evaluate potential investments and avoid overvalued or financially unsound companies. Chapter 12. Things to consider about per-share earnings. In this chapter, Graham emphasizes the need for investors to look beyond per-share earnings when evaluating a company's value. He explains that per-share earnings figures can be manipulated or distorted, making it an unreliable metric to base investment decisions on solely. Graham also highlights the importance of considering other factors that contribute to a company's financial health and growth prospects, such as cash flow, dividend policy, and earnings stability. Graham cautions against being overly swayed by companies that boast impressive per-share earnings, but may have underlying issues. He encourages investors to examine a company's financial statements and assess its profitability over time to determine whether the earnings figures are sustainable and indicative of genuine growth. By doing so, investors can gain a more accurate understanding of a company's true value and potential for growth. One key point Graham makes is the importance of understanding how per-share earnings are calculated and the factors that can influence this figure. For example, earnings can be affected by accounting methods, stock buybacks, or other one-time events that may skew the numbers. By being aware of these factors, investors can better interpret per-share earnings and make more informed decisions when evaluating potential investments. Another important aspect that Graham highlights is the need to compare a company's earnings figures with those of other companies within the same industry. This comparison can provide valuable insights into the company's competitive position and help investors identify industry trends or potential opportunities. By considering multiple aspects of a company's financial health and performance, investors can make better informed decisions and avoid relying solely on per-share earnings as a measure of a company's value. Chapter 13. A comparison of 4 listed companies. In this case study, Graham compares the financial performance and investment potential of 4 different companies to illustrate the principles of security analysis in action. Through this analysis, he demonstrates how investors can identify attractive investment opportunities by thoroughly evaluating a company's financials, business model, and competitive position. The 4 companies are presented as real-world examples, allowing readers to see the practical application of Graham's investment principles and techniques. Throughout the chapter, Graham delves into the financial statements of each company, examining factors such as earnings growth, dividend history, and debt levels. By doing so, he showcases how a detailed analysis of these factors can reveal a company's true financial health and the potential risks or opportunities it may present. This in-depth analysis helps reinforce the importance of diligent research and objective evaluation in successful investing. Graham also demonstrates the importance of considering qualitative factors when evaluating companies, such as the quality of management, competitive advantages, and industry trends. By factoring in these aspects, investors can develop a more comprehensive understanding of a company's prospects and potential risks. This holistic approach to investment analysis helps investors identify high-quality, undervalued companies that are well-positioned for long-term growth. Throughout the case study, Graham emphasizes the need for patience and discipline when conducting security analysis. He encourages investors to take their time when researching companies and to remain objective in their evaluations. By doing so, investors can avoid the pitfalls of emotional decision-making and make more informed, rational investment decisions that align with their long-term goals and risk tolerance. Chapter 14. Stock Selection for the Defensive Investor. In this chapter, Graham discusses the importance of diversification for defensive investors. He suggests that such investors should opt for a portfolio that includes a mix of stocks and bonds, ensuring that their investments are spread across various industries and companies. This strategy reduces the risk associated with market fluctuations and helps investors achieve steady returns over the long term. Graham then outlines specific criteria for selecting stocks that are suitable for the defensive investor. He recommends focusing on large, prominent companies that have a consistent record of paying dividends, stable earnings, and strong financial positions. By choosing companies that meet these criteria, the defensive investor can reduce the chances of incurring significant losses in their portfolio. Chapter 15. Stock Selection for the Enterprising Investor. This chapter focuses on investment opportunities for the enterprising investor, highlighting the importance of thorough research and analysis. Graham discusses purchasing undervalued stocks, investing in special situations, and buying stocks at a discount to their net current asset value. He emphasizes that enterprising investors must be willing to put in the time and effort to analyze these opportunities thoroughly. Graham also warns about the risks associated with investing in lower quality or speculative stocks. He stresses the importance of maintaining a disciplined approach and adhering to sound investment principles in order to achieve long-term success as an enterprising investor. Chapter 16. Convertible Issues and Warrants. In this chapter, Graham explores the role of convertible issues and warrants in an investor's portfolio. He explains the potential benefits and risks associated with these instruments, which can offer investors the opportunity for capital appreciation in certain market conditions. However, Graham also advises caution when dealing with these instruments, as they often involve higher risk and may not always offer attractive returns. Investors must carefully evaluate the terms and conditions of convertible issues and warrants to ensure they align with their investment objectives and risk tolerance. Chapter 17. 4 extremely instructive case histories. Graham examines 4 case studies that illustrate the importance of his investment principles in this chapter. He analyzes the performance of these companies, highlighting the lessons to be learned from each situation, including the significance of evaluating a company's financial strength, growth prospects, and management quality. By examining these case histories, investors can gain a deeper understanding of the key factors that contribute to the success or failure of an investment. These insights can help investors make more informed decisions and avoid common pitfalls in their own investing endeavors. Chapter 18. A comparison of 8 pairs of companies. In this chapter, Graham compares 4 listed companies to demonstrate the importance of analyzing financial statements and understanding a company's competitive position. He explains how a thorough analysis of financial reports can reveal valuable insights about a company's earning power, financial stability, and growth potential. Graham's comparison of the 4 companies highlights the need for investors to look beyond surface-level financial metrics and dig deeper into the factors that drive a company's performance. This deeper analysis can help investors make better-informed decisions and increase their chances of achieving long-term success in the stock market. Chapter 19. Shareholders and Management's Dividend Policy. Graham delves into the relationship between shareholders and management in this chapter, focusing on the importance of a company's dividend policy. He explains that a well-conceived dividend policy should balance the needs of shareholders for income and the company's need for growth, ensuring that profits are distributed fairly and used effectively for future expansion. The chapter highlights the role of shareholders in holding management accountable and advocating for a responsible dividend policy. By understanding the implications of a company's dividend policy, investors can make more informed decisions about their investments and better assess the prospects for future income and capital appreciation. Chapter 20. Margin of Safety as the Central Concept of Investment. In the final chapter, Graham reinforces the concept of margin of safety as the cornerstone of his value investing philosophy. He explains that investing with a margin of safety, where the price paid for a security is significantly below its intrinsic value, reduces the potential for loss and increases the chances of success. This approach serves as a buffer against market fluctuations and uncertainties, helping investors protect their capital. Graham emphasizes that the margin of safety concept should be applied to both individual stock selections and the construction of an overall investment portfolio. By adhering to this principle and conducting thorough research and analysis, investors can minimize risk and maximize their chances of achieving long-term success in the stock market. Overall, The Intelligent Investor by Benjamin Graham is a timeless guide to value investing that stresses the importance of thorough analysis, long-term focus, risk management, and a disciplined approach. By understanding and applying the principles and techniques discussed in this book, investors can develop a solid foundation for successful investing, regardless of their experience level or investment style. Here are 3 actionable items based on The Intelligent Investor by Benjamin Graham. 1. Focus on a company's financial health. Delve into a company's financial statements, such as balance sheets and income statements, to assess its financial position. Pay close attention to factors like debt levels, cash flow, and profitability ratios, which can indicate the company's ability to weather economic downturns and grow over time. 2. Apply the rule of opposites. Be aware of market sentiment and recognize that periods of extreme optimism or pessimism are often followed by reversals. When the market is overly optimistic, exercise caution and stick to your value investing principles. Conversely, when pessimism is widespread, view it as an opportunity to find undervalued investments. 3. Investigate special situations. As an enterprising investor, actively seek out investment opportunities in special situations such as corporate restructurings, mergers, acquisitions, or spin-offs. These events can create market inefficiencies and mispricings, offering the potential for significant capital appreciation when properly analyzed. As we explore the teachings of Benjamin Graham and the principles of value investing, it's essential to consider how these timeless concepts apply to our modern, rapidly evolving world. So, let's ponder this thought-provoking question. In an era marked by disruptive technologies, unprecedented market volatility, and the increasing influence of algorithms and AI, how can the core principles of value investing help us navigate these complexities and make wise investment decisions that stand the test of time? Thank you for tuning in to our financial adventure, where we explore personal finance through some of the most insightful books in the field. If you found value in our book summaries and actionable items, we encourage you to follow our channel to stay up to date with our latest content. And if you have any suggestions for future book summaries, we'd love to hear from you. Until next time, keep learning, keep exploring, and keep investing in yourself.